Let me just record it. Right. So we're gonna start on week 5. But now before we go to week 5 shortly, I just want to clarify. We must just go through the Fibonacci tool.
Yes.
Yeah, I'm not gonna my video but yeah, I did
say
you managed to see them, right?
Yes, I managed to see them all.
Right. Now, start my Fibonacci retracement levels in relation to day trading, because you normally use them for day trading, my fibs. So start my Fibonacci levels. Right. I'm just gonna grab mine here and draw them. Right. So you can see Kuti.
I'm just gonna screen range.
Okay, let me share the screen. Let me share the screen quickly.
Yeah, perfect.
Right. Let's do this. So my fibs, you normally use them for day trading, short-term trading. You can also use them for like swing positions, but you wait for quite a long time for price to retrace. So you use your fib tools to gauge the retracement. Where is price likely to find support? Kind of price is bullish, or where is price likely to find resistance? Kind of price bearish. Now, retracement. You only look for a retracement after there's a price impulsive move, when there's a clearly defined directional bias. That's where you have to look for, say, okay, I'm going to look for a retracement. How then do you look for that? You see, like here, when we look at this is dollar index, right? Just grab my annotation too. So this is dollar index. Price has been bullish for the past 10 to 12 weeks now. Price has been bullish since July. You see, since July, price has been bullish. And each and every time there's a drop or bearish candles, right?
Yes.
Each and every time there's a drop, that's a retracement, right?
Yes.
Every down candle is a retracement. Now, you can clearly see that every down candle is retracing into discount. You see? Every down candle is retracing back into a discount array, and then it finds support, and then it pushes to the upside. So your anticipation skills now of when there's like an expansion. So we're going to look at how then do we define, say, expansion on a daily chart. This is when you see like big bodied candles and a huge volume. You see like these ones here. You see these big expansion candles that probably create a new high. Those are the ones you need to focus on. So for instance, we've got this candle here.
Yes.
See? That's an expansion. Market retraced back into discount here. What discount do we have? We've got this level here, fair value, old loss, price run stops, and expanded to the upside. So the moment you see a daily candle with such an expansion, right, we're going to talk about this guy. That's the guy that we are focusing on. The moment you talk about, when you see that type of price action, now that's where the Fibonacci retracement levels come in. So I'm just going to draw them random here so that I can clearly just go through them. So you've got your starting point, which is right here. So when market is bullish, when you plot, when you draw my Fibonacci tools, you draw from low to the highest point that was created, low to high, for you to find retracement levels to go long. When market is bearish, it's the opposite. You draw your fibs from high to low for you to find retracement levels for market to continue going to the downside. I'm going to give you examples of both scenarios. It's clear drawing. So now we are focusing on the expansion that we saw on dollar from, so this is Tuesday, no, this Wednesday, Tuesday, Monday, on Thursday. That's our focus. Yeah. That means we grab our fib to the low of Thursday to the highest point that was created, which is up here. That's the highest point. And then we eventually saw a down close candle. Now, this is on a daily chart. Take note. Yeah. Thursday and Friday, they were all up close candle. Then we got Monday, price trading lower. The moment you have Thursday and Friday showing you an expansion of market wanting to go to the upside, that's when you apply your fib tools. Now, your fib tools have got levels, right? We've got, so we draw from low to the highest point. That's our fib tool. So from low, that's 100%. If price comes back from the high all the way to 100% retracement level, it's no longer a retracement. It's now a reversal. Market would have reversed. Yeah, it would have reversed this expansion. Then we get the 79% retracement level. 79% retracement level, market will be approaching oversold conditions. So you just have to be careful to use the 79% retracement levels for entries, because right now it's a market which is bullish. So we are looking for where price could go to the downside before it starts moving back up.
Upside.
So then we've got 70% retracement level, which I refer to as optimum trade entry. This is the optimum level for long entries when you're looking for a retracement to the downside for a move to the upside. Then we've got the 62% retracement level from 79, right, all the way to the equilibrium point. You see, the equilibrium point is the middle part of the low and the high. So that's the 50% retracement level. So we've got equilibrium, 62%, OTE, and 79. This is a range in price. You see, that's a range in price that you hunt for long opportunities, right? If you have fib tools on your charts, you're also going to have targets. Now, these are retracement levels. From here, it says first profit scaling. That will be your first target, as in your take profit. Meaning if you buy, say, around 105.65 or 105.76, your first take profit target is up here. Then you get also target 2 and then symmetrical swing, right? So in most cases, you use target 1 as your take profit. First profit scaling, this is where you start trail stopping your position so that you don't lose on your target. So once you have your expansion clearly defined, you go now to H4. Or if you're going to use the daily chart, right? The hourly chart, but we're going to go in stage. So you can see our expansion now is now more defined, the low to the high. Now, look at the gray shaded area. Equilibrium to 79% retracement level. What discount area do we have? We've got fair value. You see?
Yes. Yeah,
price
fair
came,
value.
Yeah, price came and filled up right here, that gap.
Yes.
This gap was filled. Once price filled up that gap, it was just below equilibrium. Now, your retracement levels, they become high probability. and a PD array that is accompanying them. If it's just a retracement level without any PD array, you just have to be skeptical a bit. It's not high probability. So you can see here, our premium, our discount zone has got a confluence with a fair value gap.
Yep.
You see? So if we go further to hourly chart, now on the hourly chart, this is the gap. Remember, this is for your day trades.
Yes.
Meaning inside this range here, the white shaded area, that's where you'd have anticipated price to go long. You see?
Yes.
Now, if we're talking of the opposite, we go to, let's see, we go to Euro USD. Remember Euro USD, remember that hourly bullish order block? Remember from last week?
Yes.
See what happened
Yes.
here? Then price pushed to the upside. So now, for an illustration of impulsive swing to the downside when market is bearish, so we've got our Thursday high, you see? Thursday is high up until Friday low, right here, right? So the opposite applies now. Equilibrium end above all the way to 79%. You can see now my retracement levels they've become opposite now. You see?
Opposite,
yeah. Because now we are looking for shorting opportunity because market is going to the downside. So between the equilibrium point and the 79% retracement level, that's your premium range. You need to be in a position to find premium arrays inside that range for you to sell. So when you go to the H4 chart, you see our expansion high to low. We've got fair value here. Right here, we've got the first fair value gap. Then we also have one from here to there. See?
Yes.
That's our fair value gap. And this time price went all the way to 62% retracement level. It just missed the OTE, which is the 70% retracement level. It just missed it by a few pips. But you can see how price find resistance. Like the buyers couldn't keep pushing price up. The moment price reached the premium range, which is from equilibrium to 79%, price was finding resistance. That's on the H4 chart. When we go to the hourly chart now for your day trades, right? Hourly chart, you can see there, this is our premium array in the form of a fair value gap. And you can see how price expanded. London open, you see, London open right here. That's London open today. An expansion to the downside. Where did market go? Session lows all the way down, 60 odd pips. Now this is for your day trades, your intraday trades. But what I'm trying to illustrate now is when you're using your Fibonacci tools, you need to see an expansion, right? Like for instance, right now you can see on gold, right? This is gold daily chart. Price has just been expanding all the way to the upside.
Yes.
See? Price has just been expanding. If we go to the weekly chart, this is the weekly chart. Price has expanded from a weekly bullish order block. Right. Meaning price has found support, right? The buyers have found support there. Price is now pushing to the upside. On the weekly chart, our expansion starts from this low to the current high. You see, that's the expansion because we haven't seen any movement to the downside yet. So you can clearly see that our discount is coming in from here, this level here, equilibrium, all the way to the 79% retracement level. You must take note of these levels that I marked, and then you just follow through. Like when
Okay,
price comes
yes.
back. Yeah, when price comes back to those level, and just follow through. So you can see this gray shaded area from equilibrium to 79%, right? That's our discount range, right? That discount range already on the weekly chart, we've got a fair value gap right there.
Yes.
See? We've got a fair value gap. If we go to the daily chart, let me just maximize this here. Inside that discount range, we've got a daily bullish order block. It's still inside that equilibrium point. So now you see the difference of looking for retracement levels using the weekly chart and the daily chart. You're going to have to wait now a couple of days for price to what?
Come down.
To come down, you see?
Okay.
To come down to your point of focus, your point of interest. You're going to have to wait for like maybe a few days, or it can be weeks. So once you go to the H4, and this is now H4 chart, you can see on H4, you've got expansion, retracement, expansion, retracement, expansion, retracement. Price is just pushing all the way to the upside. Yeah. And then let me see if I can show you another example. I needed one with a down price action. Right, Aussie dollar. You can see the Aussie dollar with an expansion right here from premium. Price was expanding here from old consolidation, 62% retracement, optimum trade entry. What premium array is here? You got fair value gap. You see? There's a fair value gap. Prior to today's candle, there was a gap there. You see?
Yes,
this candle's high, which is, you see now, this is now our retracement. You see, once that gap was filled, let's go to H4, which is right here, this candle here. Once that candle filled the gap, you'd have been looking for shorting opportunities. You see, shorting opportunities. Even right now, on this chart here, you can see prices expanded to the downside from a fair value gap on the daily. You see that expansion here from here to this low. That's an expansion, right? That expansion now, you're now defining where you can go short. We've got fair value gap right here. You see, our premium range is from equilibrium to
79%.
Right there. And we've got fair value gap. We've got a high probability bearish order block. You see, we've got a high probability bearish order block. So you'll be anticipating now price to return to this level, which is the retracement, and then you go short. You see, so you use your FIP tools to highlight areas where price is likely to retrace to for you to trade, and then you've got your targets. First profit scaling, target 1, stop loss. If you sell inside this premium range, for example, your stop loss should be above the 100% retracement level, because if price does come up here, you see, if price keeps pushing all the way up here, it's no longer a retracement, it's now a reversal. The chances are very high price will just keep going up. Vice versa, when price is
how many pips now when you go up, let's say, like what you said, above just 100% or on 100%, how many pips now?
15 to 20 pips.
That range can give us 15 to 20 pips.
Right. So you see now, let's say you are entering at 62% retracement level right here. You see? Let's say you are entering when prices filled this fair value gap, for instance, right? Prices filled the fair value gap right here. From there to here is like 19 pips to the 100% retracement level. You see? It's 19 pips. Then we add another 15 to 20 pips. So we're just going to say 40
Pips.
Pips, you see? So that will be
That's
your
where you
stop
put
loss.
your- Okay.
That's your stop loss. Because if price does continue all the way up there, it means there's a change in market structure. It has broken already above this high.
Okay.
So the chances are very high that it's going to go create a new high, retrace, and then continue going.
Okay. Okay.
That's how you save. Yeah, that's how you put your stop loss. Then if your stop loss is 40 pips and you're entering right here on the fair value gap, let's say this fair value gap has been filled, and your stop loss is 40 pips, your first profit scaling is coming at 45 pips. Target 1 is coming in at 63 pips. Target 2 is coming in at 86 pips. Look at target 2. Target 2 price is trading down to your old low. You see?
Okay.
Yeah. So that's just in a nutshell, because you have already watched like some of the
Yes.
Yeah.
And I think it's much easier to trade uchishandisa mafibs compared pane zvimwe zvese zvandakadzidza. I think with uchishandisa mafibs ukakwanisa kumaster
right. Mafibs unoziva kuti anonyanya kubatsira pachii pacalculation yema-stop loss nema-targets.
Okay.
Pasina, let's say tisina kuisa fib 2 here and let me just clear this. If we don't have a fib 2, we will see that there's a bearish order block right here, right? Which is high probability, and it's got a fair value gap.
Yes.
We are going to wait for price to reach the equilibrium point of the order block. At times it does not reach. You see?
Yes.
At times it does not reach. Like what happened here? You see, we've got this bearish order block here, right?
Yes.
But that's not a high probability, you see, because it doesn't have a fair value gap. We also have this order block here, which is high probability, but price hasn't retraced back there. So now the chances of price coming back here, they're quite high now. The first, this one here, the first bearish order block, because it's a high probability. But in cases where there's no fair value gap here, if we don't have the fibs from this high to this low, we are going to miss this entry because we'll be waiting for price to come here.
Like what happened last time, Papaya, delete that one at price like Chambo. We have that.
Yeah, my limit orders there. And one.
Yes.
Usina kushandisa my fib tools. You are going to wait for price to reach this top bearish order block here, right? But price is not gonna, it doesn't get there because the price is already established its intended direction, which is downside, right? Downside, retracement, downside, retracement. So we anticipating another push to the downside here by end of the week for price to trade below 0.6285. So you'd have waited, and then once you wait, these two bearish candles here, 1 and 2, you see these ones?
Yes.
They're going to mess up with your head. You're going to be cursing at yourself to say, oh, I missed 47 pips, right? The moment you do that, you're going to sell now inside this current candle, which is a wrong place for you to sell.
Yes.
That's totally a wrong place to sell. So the fib, they do help now in showing you like proper levels of price where you can go short or go long, and it can help you in establishing like your targets to say, okay, I'm going to target this this level here of price. So we will continue utilizing, illustrating how to use the fib tools and also how to apply them in real market structure.
Okay.
So now we are continuing. We spoke about day trading in week 4, right?
Yes.
Week 5
Yes.
now. Week 5 is going to focus more on scalping.
Okay.
Right. So we've got amplified day trading and scalping concept for week 5. That's what we are going to be focusing on in week 5. So amplified day trading and scalping concept. So we started with swing trading. We went to short-term trading. We went to day trading. Now we are on scalping. Now, scalping is basically trading short time frames, as in the smallest time frames. You can go to as small as 1 minute candles for you to trade. So you're looking at the time frames from 1 minute, 5 minutes, 15 minutes, and maximum 30 minutes. That's scalping. So you're trading on the lowest time frames for trades that you are going to get in, and you have a specified target to say, no, I'm only looking for 10 pips, I'm only looking for 20 pips, and then you get out of that trade. That's scalping. But we're going to talk in detail more in regards to that. But to begin with, right, amplified day trading and scalping concept, there's what we refer to as the sentiment effect. The sentiment effect basically shows you what is the market doing, right? Sentiment is basically you looking at price action and seeing, say, big bullish candles to the upside. Instantly, you know that market people are buying. If you see big volume candles going to the downside, bearish candles, you already know that people are selling. You see, the sentiment effect. So if we go to, say, the chart, right, then we go to, let's go to daily chart. This is Euro USD. You can see that big moves are happening going to the downside, right? Market is bearish. So that's the sentiment. It means market is bearish. The sentiment is bearish. If you go to, say, USD CAD, you can see big moves are happening going to the upside. So that's the sentiment on USD CAD is bullish, right? Now, when you are scalping now, right, you need to ask yourself, or you need to know, when are buying or selling probabilities highest? We've just spoken about the other one just now, right? The Fibonacci retracement levels, right? So for day trades, the use of the Asian range and the opening price is key, right? For day trades, if you're going to scalp or if you're going to day trade, knowing the Asian range and the opening price for the day is very important. Day trading. So if market is bearish, right, ideally above the opening price and or Asian range high, that's where you have to look for selling opportunities above the opening price and or selling and or Asian range high. Let me show you on the chart, right? If market is bearish, let's go to Euro USD, right? Let me illustrate this. So this will be a day when we would have been looking for shorting opportunities, right? So market opened. Where is our opening price? Right there. You see? Right here. That's our opening price. And the Asian range started from 3, which is like this candle, all the way to 7 a.m. Let me see if I can mark it out properly. 2 a.m. right here, up until 6, 7, right there. So these 2 candles high right here. So that's our Asian session, right? So we have already marked the opening price, which is right here. Let me use a red line because I need to remove those other lines. So the red line represents our midnight opening price. And then we get into Sydney session, Aussie daybreak, and then Asian session. Now, the moment you are looking for shorting opportunities, when are buying or selling probability highest, right? So during a bearish short day, ideally when price is above the opening price and or Asian range high, that's when you have to look for shorts. When price is above your opening price for that day and the Asian range high. The Asian range high is an option, but price being above the opening price of the day, you see? Now, when you're looking for shorting opportunities, say today, once you wake up 7 a.m., you're up, and then you see this price action. You already have Asian high and Asian low. You've got your opening price right here. All the while, when price is up here, right there.
Yes.
That's where you are hunting for shorting opportunities. Let me put this color, is not good for the eyes. I need something different. Because you'd have already noted that today Euro is going to provide us with shorting opportunities. So where is it ideal for you to be a seller? So as long as price is above the opening price for that day and above the Asian range high, then you should be hunting for shorting opportunities. Now, we are talking about day trading and scalping. Now, this chart is an hourly chart. We already have yesterday's high, right, which is here. This is yesterday's high, this down candle here. That's yesterday's high. If you're looking for shorting opportunities, as in scalping, the moment price is above that opening price, this is all London, you see? That's all London session. Price is above the opening price. You go to a 15-minute time frame. Price above the opening price, and it's also above the Asian range high. So all this price action in this different color here, you're looking for shorting opportunities. If you're looking for shorting opportunities on this area here, once you go from hourly, you go to 30-minute time frame. On the 30-minute time frame, you've got fair value there. You see?
Okay.
You've got a fair value gap, right?
Yes.
That's an area. You see, this range here, you're looking for shorting opportunities. Now, this is London session, right? It's like in the morning. This is what? 9 a.m. 9 a.m. today, if you are day trading, if you are scalping Euro USD, 9 a.m. today, let's see if there was any fundamentals economic calendar. What do we have? You see, we've got Euro fundamentals right here.
Yes.
Euro fundamentals, people were speaking, these ECB people, German Buba, whatever, speaking. So you can see the chances would have been pointing to a high probability shorting opportunities, both at 9 a.m. and at 11. 11, that's where CPI came in. You see, we had CPI for Euro. It remained unchanged. So you can see how price respected this fair value gap at a day when you're looking for high probability shorting opportunities. You see. So once price is above your opening price level and above the Asian range. Sorry. And above the Asian range, that's a high probability shorting scenario. That is if market is bearish. The opposite applies if market is bullish. If you're looking for price to go long, the opposite applies. Ideally, below the opening price and or Asian range low. Below the opening price and or Asian range low. So the Asian range low for bullish days and the Asian range high for bearish day, it's optional. You see?
Okay.
It might be above the opening price, but it might not be above the Asian range high. It might be below the opening price, but it might not be below the Asian range low. So the Asian range low and Asian range high, that's optional. So if market is bullish, you need price to be below. Let's go to USD CAD for clarification. So this is USD CAD. This is our opening price for the day right there, right? That's our opening price. This is a daily candle. Just gonna go to the hourly chart, Control Y. So price opened right here. And then we have our Asian range starting from this green candle all the way to this high, 7 a.m., 6, 7, down there. That's, you see, this is our Asian range session. So our Asian range low is right there. That's our Asian range low. So anytime when price was below the Asian range low and or no, below the opening price, so we're talking about this area here. You see, that's coming in around London open right here. London open 9 a.m., 12 noon, still heading towards New York opening. So inside this price action, that's where you'd have been looking for long entries, because you are anticipating market to expand to the upside. Now, that's on the hourly chart, and you only mark this maybe like 6 or 7 a.m., right? Once you have a clearly defined directional bias to say, okay, I'm going to be looking for long entries or short entries, you see. Now, anytime when price is inside this differently colored area, you'd have been looking for longs, because price is below the opening. The opening is 1.3645. That's the opening. Asian range low is coming in at 1.36300. So the conditions were met, were fully met for an ideal bullish long day, ideally below the opening price and or Asian range low, right? With the sentiment that we have on USD CAD, which is bullish. The moment you see that price is now dipped below the opening price and is also dipped below the Asian range low, so chances are very high we're going to see an expansion. If you're scalping, you start going now on the 30-minute time frame. You define your discount area. You can see we've got fair value there.
Yes,
that's a fair value gap on the 30-minute time frame. If you want to go on the 15-minute time frame, you can see we've got a bullish order block right there. That's a 15-minute time frame, because you're now going to be scalping, right? You're now going to be getting in, and the moment you're scalping an entry from here, and then you get this expansion of almost 20 pips. That's a trade, you see. But now when you're scalping your targets should always be like old highs, you see. They give you a better return, you see. So targeting this old high from the Asian session would have given like 32 pips. or targeting yesterday's high, you'd have got 77 pips, you see. And by the time price moves all the way up here, your stop loss is no longer down there. Your stop loss, you can move it up. You're safeguarding yourself from losing, you see.
Okay,
so that you can move your stop loss, you see. Your stop loss, you can move
it.
Yeah, you see. You can move a stop loss. If you open a position, you can adjust your stop loss. The only thing which you cannot adjust is the entry price. You see.
Okay.
You can never change an entry price. Once you enter, you have entered. But stop loss and take profit, you can always adjust those levels. So the market will have a short-term shift in sentiment, right? And less informed traders will chase price on the impulse or initial swing intraday. Now, if market sentiment on USD CAD is bullish, how many people do you think started selling after seeing this move to the downside? A lot of people, those who are less informed. You see, same applies on Euro USD. The moment we go to a 15-minute time frame, when market started going up here, a lot of people would have been buying. You see, the less informed people would have been buying here and putting their stop losses down there. By the end of the day, those people are already crying. You see, they've lost. So the market will have a short-term shift in sentiment, and less informed traders will chase price on the impulse or initial swing intraday, focusing on strict conditions like daily or H4 directional based institutional order flow, and combining PDRA matrix for next level objectives will provide you with highest probability setups. This is basically you focusing on what the daily or H4 direction is, right? USD CAD, we saw that the directional bias is bullish. Euro USD, directional bias for the daily chart is bearish, right? So you wait to enter on opposing market direction for high odds. Opposing market direction, for instance, if we go to Euro USD, opposing market direction is basically this whole price action. Market is opposing the move to the downside. Is it? Then if we go to USD CAD did not oppose that much, but from opening, this is our opening price. This here, the candle would have been bearish. By the time price dips down off below the opening price, it means that daily candle is bearish. Yet you are anticipating that candle to close bullish. You see, you are anticipating that candle to close bullish. So when you look at when are the probabilities high for you to be a seller or for you to be a buyer, the first point of call, if you are scalping, right? If you are looking for short opportunities and you know that your directional bias is bearish, you need price to be above the opening price for that day and or Asian range high. Then for long days, ideally, you need price to be below the opening price and or Asian range low. That's when you're going to get high probability opportunities, right? So the sentiment effect, buying conditions, the proper setup for long entries. So when IPDA suggests a daily or a minimum H4 discount array is in play, right? When there's sufficient range in pips between market price and opposing premium array. So when IPDA suggests a daily or minimum H4 discount array is in play, that's where you need to see that price has found support on either a daily bearish order block or a daily fair value gap or a daily liquidity void, you know, those discount arrays. Once you have that, then you should consider scalping. If you don't have a discount array on H4 or daily supporting price, then scalping might be difficult because market can instantly move against you and go to the downside.
Opposite.
Yeah.
Okay.
So the proper setup for long entries: price declines under the opening price and the Asian range low. That's what we have been talking about now. Ideally, the decline under the Asian range low will be to a logical discount array on the 15-minute time frame. Let's go to USD CAD. The discount array will be to a logical, the decline below the Asian range low. This is our Asian range low, right? The decline below the Asian range low will be to a logical discount array on the 15-minute time frame. This is a 15-minute time frame, right? And that decline has traded back to a 15-minute bullish order block, right there. You see?
Yes.
If we go to, let's go to Euro USD, right? This is now for sell, right?
Yes.
The rally to the upside has to trade into a premium order block. The rally to the upside on the 15-minute chart, it has to trade into a premium order block, right? We've got fair value right there.
Yeah.
And you can see price is above the Asian range high. Price trades into a 15-minute premium array, and then it expands to the upside, to the downside, I mean. So when you are scalping for your buy conditions, right? For your buy conditions, ideally the decline under the Asian range low will be to a logical discount array on the 15-minute time frame, right? Price will not spend much time at the discount array on this 15-minute. Expect price to sharply trade higher away from that discount array. Expect price to sharply move away during London Open. The longer price stays or hovers near that 15 discount array, the odds are going to drop for a trade. Short-term sentiment will be most bearish at the time we enter long trades. So when you're buying, first thing that you do, see if price is above your opening price, then see if it is above Asian range. When you're buying, see if price is below the opening price and also below the Asian range low. The moment it's below the Asian range low, see if you can highlight fair value, meaning discount array. See, meaning discount array that you have to see. You have to see price to trade to at least a discount array on the 15-minute chart. And you can see now on my illustration here, this is a very old chart. Asian range high, Asian range low. This is our opening price right here where the dotted line is, and price does trade below it. And we've got a 15-minute bullish order block. Price does not hang around and then it expands for the rest of that day. The opposite applies when market is bearish. Now your sell conditions, your proper setup for short entries. IPDA has to show that it has found resistance on a daily or at least an H4 premium array. There has to be sufficient range in pips between the market price and opposing discount array on the daily or minimum H4. Price is going to rally above the opening price. This is what we are talking about on Euro USD. Price is going to rally above the opening price and the Asian range high. Ideally, that rally you need it to trade above the Asian range high. It should trade to a logical premium array on the 15-minute time frame. Okay. Let's go to GBP USD. Yeah, it's not sustainable, man. When the chances are there, I do scalp. You see, but I think I've just managed to keep it in check, because the moment you start scalping, you can scalp 4, 5, 6, 8 times, which you win and it. Then you think you're what? You're good at it, because scalping can mess up your equity instantly.
I see.
Yeah. So you always think, no, I can just get into the market and make money and get out. And that is not the case. That is not the case. So this is daily for pound USD, right? So IPDA, so this is market is bearish. You can clearly see that market is bearish. Our sentiment on the daily chart is bearish. And if we look at today's price action, market opened right there. That's our opening price. So now I'm going to go to the hourly chart. Control Y. Just need to mark out. So this is the opening, right? So our Asian range starts from here. That's our Asian range low. Where is 7? Where is 7? And that's our Asian range high, right there. Right, that's our Asian range high. Now we're gonna go to the 15-minute time frame. Now on the 15-minute time frame, you see price from here, right there. You see?
Yes.
That's the rally above the opening price. The opening price is right here. This is our opening price. That's the rally above the opening price and above the Asian range high. Asian range high is coming in right there. Right here, if I'm not mistaken. Right there, this candle here. So you can see the rally above the opening price and above the Asian range high. Now this rally here, we need it to trade. Ideally, we need it to trade to a logical premium array on the 15-minute time frame. What premium arrays do we have? One, we've got a bearish order block. Two, we've got a fair value gap. You see?
Yes.
And that's where price traded. So if we have a fair value gap and a bearish order block, you see, right there. That's our bearish order block, and this is our fair value gap. Look at the reaction of price inside those two logical premium arrays. This is a day when we are expecting price to close bearish. So every time, the moment the price traded above the opening price, okay, our opening price is right there. The moment price traded above our opening price, which is from here all the way, it means that daily candle is now bullish. The color itself, it's a bullish candle. Yet we are anticipating that candle to close bearish. You see? We're anticipating that candle to close bearish. So the moment you have a rally to the upside, and that rally is trading to a logical premium array, at a day when you're anticipating a market to go lower, that's when you are executing your short position on that 15-minute time frame. You are opening your scalp. The moment this gap is filled right here, you see?
Yes.
You're opening a short position. There, 22 pips. Price comes back again. Another 22 pips. Price comes back again. Another ultimately market moves 62 pips. So they would have been, yeah.
Zvakamira zvakadai. Stop loss yako inenge iri papa.
Right. Good question. You are shorting this logical premium array in the form of either fair value, gap, or bearish order block, right? So for instance, let's say you are shorting number one when the gap is filled, right?
Yes.
The moment the gap is filled, you are shorting in anticipation of market trading back below the opening price, which is going to give you like 24 pips. And you're shorting this fair value gap. You don't expect price to go above the order block, you see?
Yeah.
So 15, 20 pips above the order block. So initially from entry, you've got 9 pips to the high of the order block, plus another 20 pips. You see?
Okay.
You put your stop loss. You can use a tight stop loss. What do I mean by tight stop loss? So if you enter when the fair value gap is filled, you can put your stop loss like 5 or 10 pips above the old high. You see, that's what we refer to as a tight stop loss. The only problem with tight stop loss, if the broker or if there's fundamentals on the calendar and then the spread gets bigger, price can trigger your stop loss without even reaching that stop loss.
Yes.
See? Price will reach it without even reaching that stop loss. So whenever you are entering a position on a premium array or a discount array, right? Just try to practice putting your stop loss at least 15 to 20 pips above the premium array or below the discount array. Because a move of 15 to 20 pips above an array, in most cases, it's a change in market structure. Is it?
Okay.
Yeah. So that's what you have to focus on when you're looking for sell conditions. So the main thing here to really grasp is here. See? That. And this.
Yes.
If you're scalping. So you can never scalp if those conditions are not met. It's a very risky scenario to do, you see. If you are looking for scalping opportunities, don't scalp shorting opportunities if price is not above the opening price or it's not above the Asian range high, because you're basically gambling too much. You see, that's a bit of too much of a risk.
Okay.
Scalping when price is above the opening price and or Asian range high gives you a high probability setup for shorting opportunities. So that concludes our class for today. We're going to continue tomorrow with this amplified day trading. We're going to continue focusing more on concept that you have to understand and know when market is giving you scalping setups. So week 5, we're going to be focusing mainly on scalping and amplified day trading. Do you have any questions?
So far, and
okay, I'm gonna upload the session so that you can just go through it also.
Okay.
Yeah. And then we continue tomorrow.
All right.
All right, Baba.
Baba, tombomuka discalpa mapsini. All right, Baba.
Sharp.
Toonana mangwana.
Mangwana.
Yeah.